Hello, everyone. Welcome to the Trend Playbook. So that could mean a tripling of the price of silver at its current level to gold relative to gold on a relative level. So yeah, we argue that silver and the gold and silver miners are now going to beat music. Gold. Michael Oliver, welcome back to the channel. Good to be back, Dave. I always really enjoy our conversations, but for those that don't understand the difference, can you explain to our viewers what the difference is between momentum structural analysis and traditional technical analysis? I'll try to keep it less than 30 seconds. Everybody looks at price. Price is fine, but price can be delusional. First off, everybody sees it. Everybody draws the same lines quite often. And when you break the lines, it doesn't necessarily have the potency that you would hope or think. We study instead, we take price and we oscillate it versus certain moving averages. I don't mean we overlay an average on a price chart and any idiot can do that. I'm talking about oscillated up above it or below it and create a different chart. Momentum charts will often, usually, almost always lead price in terms of trend direction changes, topping or bottoming. You'll see the evidence on momentum first, and then you'll get smacked in the face by price later. So that's what we do in look at all kinds of markets over different time scales. And it's important to do that because we're living in a world where it's not just looking at gold, you got to look at the other stuff. And that's all very relevant at the moment, particularly when you talk about price smacking you in the face. But in looking at momentum and, price and price action can sometimes
make a liar of you.
One of the things, obviously, our audience is really interested in the precious metal. So we're going to talk about gold, we're going to talk about silver, and we're going to talk about the miners as well. But let's start with gold. I mean, we've gone through that psychological 3,000 barrier, right? And now, based on what you're saying, you're probably firmly on the side of that's a psychological barrier. Dave, and the real story is in the momentum. So what's the momentum telling us when it comes to the gold market? When you look at annual momentum of gold, and that's when you measure the monthly price action in bars, oscillated against, let's say, a 3-year average or a 36-month average. You get a long-term momentum trend picture. That picture turned down in late 2011. The market wobbled around for a year and then collapsed, didn't make a new high after that, by the way. And then it went down to 2015. And ever since December 2015, turned up as of February. Our metrics by using annual momentum, it has not negated that words. We've had plenty of stalls. We've had pullbacks. There was a 20% pullback in the 2020 to 2022 low, for example, 20%. If you consider that major, you had one, but it didn't break the major uptrend in gold. The momentum uptrend scared price people all along the way. You've scared all the price folks out, in and out, and that's the top. Oh no, etc. And for some reason, because we're humans, I guess, round numbers catch people's attention. Remember the trouble just over run. For a couple of years, we get over 2,000. They'd sell it. That's not the way you top a market. You don't go back to the high again. If you do, it says you're going through. Okay, we finally went through. Now we got 3-0 crowd. Okay, just like we have the $35 crowd on silver. Okay. And which we've been to twice now, by the way. So I think this is merely another pause point. And I think the key factor for gold has been for recent months, need to break the stock market, US stock market bubble, because when you punch a hole in that beast, the money will flow elsewhere. And historically, it has always flowed into gold. Not that gold waits for that after all. Gold's been going up anyway, right? Okay, but helps infuse the dynamics of gold because it creates a river flow of new assets are seeking safety. And I think we're already starting to see that now with the topping of the stock market. And I think the next phase up in gold will be fairly dramatic because the flow from that broken asset category will enhance it. It will also spark the central banks into craziness again. Okay, so what we're saying here is we're not just looking at the gold market, not just looking at the gold price that is in an uptrend, has been for a good number of years. Nothing's changed in that regard. Nothing, but the stock markets are going to be the next thing. That'll give it a filt to the upside. Because when we see a breakdown and maybe you might talk to that point for a moment, when you see breakdown in that stock market, trend, you're going to see an extra flow of money. And ultimately, one of the things we always say is the reason that these things break these levels to new levels is either when there's new money or new motivations for buying at these prices and above. So you're saying that that movement out of the stocks is going to find that's going to find a home in the metals. I think a lot of it already has, where smart asset managers are saying the risk reward ratio of the stock market now is questionable. And I'm going to move some assets to some other place. And if they do their homework and go back 100 years and look at the big bear markets in the stock market loop, and behold, gold went up during those times. Okay, not that that was the only factor for sure. The key factor that drives gold is the degradation of the money unit. And what causes an increased degradation in the money unit? Meaning more quantity, freer money than would be reality, central banks going berserk. Because their bubble is breaking the thing that they care about. They don't care if the price of corn is low and farmers don't make money, that's okay. But they want stocks to inflate. That's good for them. Okay. And when those break, then things like banks go down, and that's of great concern to them. And I think we're starting to see that process, the topping of the US stock market bubble, and it will flow into gold. There's very few places. In fact, if you look around the horizon that have been behaving well, haven't been behaving like the stock market. And when it goes, there's not much else out there that has its own integrity and is driving solidly north, which is how much of a correction are you envisaging? You might call it correction. You might call it something else. You're seeing a downtrend potentially emerging. Where's the bottom of that? I mean, the stock market. Yeah. I don't, except to say that it's just going to be monstrous because the bubble itself is the biggest bubble in US stock market history in terms of number of years. Up causative factors like M2 growth, Fed funds rates being off the page cheap for 10 or 15 years. And even for the 15-year period when they raised them briefly, those levels were still historic cheap. So they kept the price of money artificially low, and that created false investment, false notions of trends. And when you do that over a span of time of 15 years, you create a lot of errors embedded in the economy, embedded in personal debt. When it breaks, the central bank will try to come in and rescue it as they always do. You go back and look 2000, 2002, 2009. They cut rates like maniacs and did not stop the breaking of the bubble. Once it breaks, reality takes over. Problem is, this one is a monstrous bubble. Therefore, its consequences could be in the real world very, very bad, much like 2009 was, even if you weren't in the stock market 2 years after. That market topped 207 by 2009. Most people in the street were feeling the pain. Indeed, and this time it should be far worse. It's not just going to be the breakage of the Mag 7. We're watching in particular commercial real estate, which is a debt-laden sector, highly vulnerable. And obviously, if it breaks as we expect, and it is doing so, it will impact banks. You do that, the central banks go crazy. Yeah, when you say the central banks go crazy, you're talking massive money printing, easing everything, whatever tools they can would pull out of their quiver. Yes, but it's not going to work this time because the problem is so big, and they're not going to be able to stand in the way. Yeah, even when the dot-com broke, they cut rates in January 2001. Okay, started cutting rates. In fact, they cut twice that month. That was like 6 months off the price high, and we weren't really obviously in a bear market yet, despite cutting rates all the way down, NASDAQ 100, 82%. Okay, people forget that to end, they cut rates in a surprise rate cut in September 2007. The market went up for one more month at a joyride. Oh boy, Fed's cutting rates to buy stocks. That was the top, went down for 2 years, 2 years plus, and they cut rates all the way down. Did it stop it? Nope, the money went elsewhere, went into T-bonds. Went into gold this time. I think T-bonds will get some of the benefit, but it'll be temporary. So the money will find some of the money will find a bit of a home there. And it won't be happy because it's not going to perform the way it's performed historically, and then it's going to move on. That's right. Yeah, in other words, that rally in T-bonds, which we do kind of expect tagging along with gold is the alternative view, but it will likely measured in a couple quarters, right? You know, that's okay. You've nicely kind of joined the dots there between gold, the stock market, the three bond central banks, and map that against what's happened previously and why that will going forward. What I like to touch on silver now, because we have got a very keen interest in silver. Our viewers, do you think that it just performs the same way as gold as you have
described, or is what's the story? What's the momentum behind silver? Well, silver has alternately gained more than gold and then less than gold, ebbing and flowing over the
last 10 years?
Okay.
And especially since 2024 in March, we put out an A report arguing that the stall we'd seen in gold for a couple years sideways was over. We're going up again. Okay. We went from 2000 during that year since the not, full year now. And silver went from like $25 to 35s, a pretty good gain too. Okay. There are times when silver underperforms. Whenever gold pulls back, silver pulls back more. Okay, bigger context. Silver's ratio to gold, we measure it by dividing silver into gold, expressing it as a percent, is 1.115%. The price of gold now 1.115. Okay, if you go back 50 years and look at the highest reading of silver in relation to gold, which divides the price into the ounce of gold, expressing it as a percent, 2% has occurred in 21 of those 50 years.
Okay.
So it's almost normal. We're 1.1 fee. Okay, if we break out of the current pullback in silver versus gold, which we argue is now commencing, we're starting to see the breakout. We're going to gush not only to the 2% level, which is to say almost double the price of gold in silver in relation to gold as it is now. Yeah. Okay. But you could go further, because in bull trends like in the 79, 80 period, or in the 2010 1 period in the surge, the last 2 years of those bull trends, silver went berserk relative to gold on a percent basis. It ran way out in front of it. And the spread got up to like 3% or higher during those times. So that could mean a tripling of the price of silver at its current level to gold relative to gold on a relative level. So yeah, we argue that silver and the gold and silver ERS are now going to beat gold. Okay, going in this next year, and personally, that's where I'm invested with the emphasis in those areas. Do you generally look at kind of a price target on that, or are you just going to look at that relative to gold and just say it's going to be a high performance price targets are going to be hard to determine this time? Because I said the bubble is the biggest in history. When it breaks, the consequences will be bigger than other ones. And therefore, the dynamic in the monetary metals could be awesome. I've cited before, people say, oh, he's predicting 1,000. No, I simply said that over 50 years, gold has had two prior bull markets, each of which were eightfold moves from bear low to bull high, different span of time. One was 3.5 year process, mid 76 to 1980. One was from 2011, 11-year process, but both were eightfold moves. Well, an eightfold move for us now would be 8,000 plus, just to match the ratio moves of those two prior markets. And the conditions that drove gold up then were hardly as dynamic under the surface as they are right now. So if gold went way past 1,000, went to 20,000, it wouldn't shock me. I do not have a specific target. Yeah, except to say seed belts, and what you're talking about there. When it comes to stock markets, and then kind of temporarily, moving temporarily potentially into the bond market, and then into metals, ultimately, one of the ways that we like to discuss precious metals with our clients is it is the best way to take wealth out of the financial system. It sits on the sideline. It doesn't do anything. It's nearly like it's not an investment. It's an anti-investment. But when you get that wall of money and that wall of investors trying to exit effectively an unlimited financial system, MH, an infinite financial system, go into a finite resource, gold and silver, and anything can happen with the price. Ultimately, yes, that's precisely. Therefore, I cannot come up with technical swing objective targets on the upside, except to note what has happened over the last 50 years is two eightfold moves under conditions that are hardly as dynamic as what we're sitting on right now. So and also another thing, a point I make is I don't think the next quote, Dolphin Gold, wherever it may be next year or so, probably is going to be a top as we normally think of one. I think it's simply going to be a new price level reality. Okay. It's not going to collapse back $500 an ounce or anything like that. I think the world will go to gold because the financial crisis that follows the stock market bubble breakage will cause rethinking of many things, rethinking of the validity of the intellectual viability of central banks, for example, and move back to gold standard currencies, a relearning of the importance of gold in the financial system and in the monetary system. Okay, let's just briefly talk about the miners in terms of momentum and what you see happening there. Well, they surged out in front of gold dramatically during the 2020 surge in price. That's when we remembered the Coal event and the Fed came in and printed in gold sorted, but silver and gold vastly beat gold during that 6 to 9 month period. I mean, they trounced it. But then during the period from mid-2020 through about late 2023, they underperformed, meaning while gold went sideways, they eroded downside as staircase. We technically monitor those spreads. We don't just plot the spread chart, which anybody can do. We do momentum studies of them. And also what we see with the miners is the same thing we see with silver. We see the technical dynamics of an upturn. In fact, we're on the cusp right now this month of posting a close where you measure GDX, for example, versus gold, or the X index versus gold. And we're registering a breakout, meaning the performance breakout is occurring at that point. We expect the miners to beat the pants off gold as they do periodically. And I think this is in part also due to the breakage of the stock market. Because a lot of people in the stock market, when they exit, they're not going to go out and buy silver futures index. Okay. They're going to buy stocks and frankly, the gold mining stocks in relation to the S&P, gold mining stocks in relation to gold are vastly cheap. And if not gone lower in terms of relative performance. If you go back to 2015 when they were bombed, net price, but also relative performance of the miner, they've never gone lower than that. They've been higher than that level for the last 10 years, meaning the miners, despite the fact that they're not above the 2020 price, highs are actually up more on a per index, for example, is up more on a percent basis from its bare low in 2015 than is gold. Tell somebody that at a cocktail party and they'll spill their drink. But it's a fact they're actually, the X is up more than gold is over the last 10 years. I think it could rush to the upside. We think the potential there is for a tripling of the valuation of miners where they currently are to gold to where they could be over the next year, Okay. So that's not a tripling of the miners. That's a tripling of the miner really. Yeah. I mean, if gold goes up another threefold, let's say miners will go up, ninefold. Gotcha.
Yeah, three times the amount and etc. You get the point.
So we think that the dynamics are for silver and the miners now, and that's where I'm personally viewing 2025 as being the best place to be. Fantastic. Now we've talked about gold, we talked about silver, we've talked about the miners, but we've also touched on the stock markets and the bond market as well. You've given your insights into how you believe the central banks will react. Is that the full picture of everything at the moment that to understand the gravity of what's going on at this moment in time? Yeah, I think the banks will do what they normally do, although, I've argued the last year that this next crisis, when it unfolds, could lead ultimately, not initially to the abolition of central banks. It's already been talked about here. And if you give the current administration and the congressional powers that the excuse a justification, then that's going to be a topic. The abolition of the central bank, after all, it's only been around for one very long human lifetime. It's not like it's been around for 250 years, and it's clearly not associated, but it's a cause-plus factor of the boom-bust cycles. You get a monetary boom-bust cycle, and you lag it about a year, and you start to get the stock market boom-bust cycle, and it's caused by excess money flow and interest rate manipulation. I've made the point before that, we denounce communism, for example. If you saw the streets of Moscow in the 70s, there'd be people lined up outside of a bakery to get their bread, or they're outside of a meat market to get some meat. It's rationed by the government, controlled by the government, pricing, quantity, etc. Well, that's what the central bank does, the most essential commodity. In human interaction is money between you and me, between you, me and a Chinese exporter, buying product or something. I know him. He doesn't know me, but I appreciate what he does. I give him money, he thanks me, and he provides a product to get the point. But it's the money unit, it's the essential transactional object, commodity, and yet government declares monopoly control over it, the quantity of it, and the pricing of it. No wonder you have distortions. No, anyway, I don't know why that concept hasn't smacked people in the face that we have communist money. In effect, it's controlled by the government from above, market. So it's not a particularly rosy future that you're painting here. And it's really important that people understand the type of perspective that you hold and that you have described. Where can anybody viewing this video find out more about what it is that you offer? Well, our site is Oliver MSA Commentum Structural Analysis. Take your time, tool around on the site. We explain in pretty good depth our methodology, why we have a different methodology, why it's unorthodox. We show you a lot of our archive reports, tops and bottoms of the stock market for the last 20 plus 30 years or so. We've been around since 1992. Many of our clients initially, we only sold to institutional clients, provided research to banks, hedge funds, major mutual funds. But we expanded out to retail clients after starting in 1992. But anyway, it's take your time, look at the site. And if you want some sample reports, request them. Well, I have your service. I find it incredibly insightful and incredibly useful. It helps me guide me in my decision making. So thank you for your continued excellent work. But for now, I hope to have you back on the channel again soon. Michael, but for now, Michael Oliver, thanks for joining us on the channel. Thank you.